Good afternoon. So, one of the things that happens when mortgages get stupid expensive is people try to find out ways around that or find creative financing. And as real estate agents, it's not a shock right now to see listings advertised as either they'll buy down the rate, or the seller will, or they will do a loan assumption. And while that's great and all in theory, in practice, it's pretty awful. So I wanted to go over something that I saw, and then we'll talk about it a little bit, and that will be it. Here it is. It says, mortgage rates fuel buyers' remorse, create opportunities for loan assumptions. Oh, great, right? Oh, great. We don't need to get a really high mortgage. We can just assume one. So are you giving buyers false hope? Yeah, pretty much. I mean, just my experience. But, we'll go over it. So let's get into it. It says, the current housing market is a mixed bag. From home prices to inventory, potential buyers and sellers are wondering where they stand, and mortgage rates are fueling a lot of uncertainty. It says mortgage rates aren't expected to dip below 5% again until about 2025, said Erica Giovanetti, loan expert for U.S. News and World Report. So let's try to figure this out. So it says the current housing market is a mixed bag. It's not really. It's still in St. Louis a seller's market. In other places, it's not so much. But even with a seller's market, with the mortgage rates hovering around 7.5% to 8% on a 30-year fixed, that's not helping things. So if people are buying now, they're paying an awful lot in interest, and prices have not gone down, at least not in St. Louis. Now, other places, it looks like there is some easing, and that would help with affordability. That's the main problem. It's the affordability, the ability for the buyer to actually get into a home. And so, like I said, when things like this happen, you'll find creative financing comes into play. And so let's continue. It says the survey found that more than half of recent buyers regret taking out a mortgage when rates were high, and 78% said they were at least somewhat stressed. Interest rates will remain high for the rest of the year, and 84% plan on refinancing to a lower interest rate in the future. It's fascinating to me how you could make a definitive statement, interest rates will remain high for the rest of the year. I don't know if they will or not. I have no idea. I can envision scenarios where it's possible that rates could come down quickly. That promise of, you'll be able to refinance down the line, while it's true, it might just take a little longer than some people initially thought. Now, this has been my concern. This is what I've told my clients, my buyer clients, the entire time. So all these lenders are out there, and I'm not a lender, but I don't have a problem with lenders, but they say, you'll just be able to refinance later, so it'll be fine. Now, to me, that's a little disingenuous because we've seen a massive run up in properties. So if you buy a property, let's say you buy a property that's $500,000, okay? And then you want to refinance down the road, okay? Well, let's say that the property value drops to $400,000. You're probably not going to want to refinance. Or if you are, you're going to be bringing money to the table, which would be bad. So you're in a negative equity situation. So I never was a big fan of that. Now, over time, over 30 years, is there a chance that at some point in time you wouldn't be in a negative equity situation, therefore refinance at a super low rate would make sense? Yes. But, I mean, we're talking over 30 years. That's a long time. Or even just do 10 years. I mean, it's just an issue. And so it says conditions in the housing market have buyers and sellers using under the radar benefits to avoid higher interest rates, including mortgage assumptions. Now that's true, but I haven't seen it. And can I just offer that there's something fundamentally wrong when you can't get a mortgage for a property with favorable rates. And rather than that, you have to find some sort of way to creatively finance the property. That just isn't going to work. I mean, it's just a bad deal. So It says, in this market right now, you can take over a VA homeowner's mortgage, and that includes their interest rate. According to the data from Ginnie Mae, nearly 9 in 10 VA homeowners have a mortgage rate below 5%. Burke says that buyers and sellers must take these elements into consideration when entering a mortgage assumption. Here comes the mortgage assumption. Well, what's that? Well, that means you get to take over. Let's say somebody has an interest rate of 3 on a property, and you want to take over that mortgage. Well, you can. Pretty crazy, huh? There's rules, though, right? It's not like it's just that simple. So you can also do this on FHA. And then so they did some things. They said, but like pay attention for buyers. It says you've got to find a way to pay out that home seller's equity. And that's the number one problem. You have to pay out the equity. Now, that's not something everybody can do, but if you do have the cash or otherwise the ability to get that financing, it's absolutely a huge opportunity that allows you to take on a mortgage with the kind of interest rate you simply cannot find in today's market. I added simply, I'm sorry. And then for sellers, it says, unless the person who's taking over your loan is another veteran who's effectively substituting their benefit for yours, you're putting the future of your VA home loan benefit at risk. So this is a whole article, okay, that says, hey, here's an idea. You can assume a VA mortgage. Like, you can't pay the mortgage, right? Can't take these rates. Well, you can get a lower rate if you just assume someone else's mortgage. As if that's so easy. Like, that's the part that drives me a little bit crazy. So I don't know if you know this, but FHA loans are also assumable. But it's not like you can just go and say, okay, well, I'm going to get an FHA loan. Here's some of the FHA mortgage assumptions. Here's some of the things that you have to have. Credit score must be 580 to make a 3.5% down payment, or between 500 and 579 to make a 10% down payment. Debt to income ratio must be 43% or less, and monthly mortgage payments cannot exceed 31% of your monthly gross pre-tax income. Now look, right now with home affordability being absolutely awful, I wonder if you could even like, it's going to be hard enough to be able to afford a mortgage at 8%. Now you've got to try and work it into these numbers here. It's not so great. Down at the bottom, here's an example, because I wanted to put this forth so that I can kind of be of assistance. Let's say a seller's home is worth $500,000, and there's $100,000 left on the seller's mortgage because they've paid off $400,000, which is the total amount of equity the seller has in the home. To assume the mortgage, you will need to pay back the seller their equity, which is $400,000. You'll either pay it in cash with your down payment or finance it with an additional loan like a second mortgage. Well, can you get a second mortgage? That's a good question. Also, one of the things that's even more horrid about this, let's say you bought a home in 2020 and it's appreciated 10%, okay? And you sell it. Those people still have to come up with what they've paid into it. And then they're not going to want to sell it at a lower price, so they're going to want it for the higher price. It's an absolute nightmare. So, you say, well, John, that's kind of a jerk move. They've put forth a thing that solves the problem, but it only solves maybe 1% of the marketplace, the entire home loan marketplace. And I agree with you. What should have happened, okay, is that as mortgage rates rose, you should see a cooling of house prices. Now, look, I'm a real estate agent. I don't want house prices to go down for my sellers. And I, for buyers, I'd like house prices to go down. So I'm conflicted, right? But my feeling right now is buyers are being shut out of the marketplace at 8% mortgage rates. And while I applaud this idea that we're going to, we're going to fix it by giving everybody an assumable mortgage, it's just not likely. It's just not likely. You got a better shot. I mean, totally being honest here, you've got a better shot of going to a new home builder and getting them to buy points off the mortgage. And so I've been seeing some places around 6% people are paying down to. That'd be okay, right? If you really had to buy a house and you really wanted to get some sort of mortgage help, that would be the route to go. But that's not going to continue forever, okay? So, and that comes with strings too. You're going to probably have to use the builder's lender. You're probably going to have to jump through quite a few hoops with that. But if it's completely down to you want to pay a lower mortgage rate, that might be the way to go. I would not recommend messing around with an assumable mortgage personally, but you're welcome to do what you want to do. But be ready for this. There's going to be all kinds of stories about rent to own is going to come back. A lease to own is going to come back. You're going to get seller financing. You're going to get all these creative ways to finance as the mortgage rate continues to go up and continues to make it more and more unaffordable to purchase a home. So with that, I'm going to head on out. Thank you for watching. Thank you for listening, and I will catch you on the next one.